Warren Buffett's 5 formulas that can change your thinking about money. Imagine a man who panics as soon as the market falls. Red numbers are appearing on his phone, messages from friends are coming in, and he is wondering whether to sell everything now or wait a little longer. At the same time, the world's most famous investor is sitting calmly. No panic, no rush, no noise. He is doing exactly what he has done for decades, understanding good companies, maintaining patience, and keeping emotions away from decisions. The fear is that a common investor often comes into the market not to make money, but to lose it due to their own mistakes. And the curiosity is, what are those simple formulas of Warren Buffett that made him a legend in the world of investing? People call Warren Buffett the Oracle of Omaha. But his real strength has not been any secret trading trick, but common sense, discipline, and long-term thinking. He spoke about stepping down from the CEO role of Berkshire Hathaway in May 2025, and in 2026 Greg Abel took over the CEO role. But Buffett's investing philosophy is still like a school for investors around the world today. Buffett's story is special because he did not consider wealth to be a race to make money quickly. For him, wealth is like a tree, which needs time, patience, and the right soil. The first formula is, never stop learning. Buffett has believed that knowledge is the biggest asset. Money can be lost, the market can change, but understanding can help a person stand up again and again. Buffett read a lot in his life. Annual reports, business stories, financial statements, and newspapers have been a part of his daily routine. He made investment not guesswork, but a learning-based decision. A common investor often puts money on a tip, a reel, or a friend's advice. Buffett's thinking is the opposite. First understand the business, then invest the money. Learning does not just mean reading finance books. It means understanding how the economy works, how a company makes money, why a customer buys, and how trustworthy the management is. When an investor learns, the fear of the market becomes a little less, because they know that they are not buying just a stock symbol, but a part of a real business. The second formula is, invest for the long term. Buffett's most famous style has been to buy a good company and give it time. The market shows its mood in the short term, but the quality of the business comes to the fore in the long term. This is the reason why Buffett focuses more on business performance than daily price movement. A common person wants to see profit the very next day after buying a share. If the price falls, the tension begins. Buffett considers this impatience the enemy of wealth creation. Long-term investing does not mean blind holding. It means that the company you have bought, after understanding it, should be given time to grow, as long as its fundamentals are fine. A good business can build its earnings, brand, and market position over time. An investor's job is not to break their own compounding by selling such a business early. Compounding looks slow, but its magic is seen with time. In the beginning, growth looks small. Later, that same growth becomes a snowball. Buffett's investing journey has been like this snowball. He did not choose the path to get rich quick. He chose the path to become strong slowly. The third formula is, understand the risk. Buffett is not afraid of risk, but he does not take blind risk. He has believed that risk increases when you don't even know what you are doing. If a person buys a stock just because it is viral, then they are not investing, they are gambling. There is logic in investment, there is excitement in gambling. The first way to understand risk is to understand the company's earnings. It is necessary to see what the company sells, how profit is made, how much debt there is, and who the competition is. The second way to understand risk is to look at the valuation. Even a good company can become a bad investment at a very expensive price. Buffett often talks about the margin of safety. That is, buying at such a price where there is some room for error and the risk of the future is manageable. A common investor links risk only to the falling price. But the real risk is the permanent loss of capital, meaning your money gets stuck in a place where the business itself is weak. Diversification can be useful for reducing risk, but Buffett's thinking also suggests that spreading yourself too thin can weaken your understanding. If you have 30 stocks and you don't even properly understand the business of 5 of them, your portfolio is definitely large, but your understanding is not strong. The fourth formula is, invest in simple businesses. Buffett prefers to stay away from complex things that he cannot understand. His concept of the circle of competence is very famous. It means that you should take decisions only in the area you understand. Not every opportunity is for you. New themes arrive in the market every day. Sometimes EV, sometimes AI, sometimes crypto, sometimes biotech. It is not necessary to run after every trend. Buffett's simplicity says that if a business is so complicated that you cannot understand how money will be made, it is better to stay away. Simple does not mean small. Many big businesses can also be simple if their product, customer, and cash flow are understandable. For example, there can be complexity in sectors like consumer products, insurance, banking, or energy, but the business model can be understandable. An investor should ask themselves, if the stock market were to close for 10 years, would I be comfortable being the owner of this business? If the answer is yes, then the investment thinking can be strong. If the answer comes only by looking at a price chart, then the decision is weak. The fifth formula is, maintain discipline and patience. This is the quality that is simple to hear but hardest to follow. The market is a field of emotions. Greed takes it up, fear brings it down. Discipline saves an investor from both. Instead of buying or selling in a panic, Buffett waits for the opportunity. For him, holding cash is also a decision, not a weakness. When there is a lot of enthusiasm in the market, many people overpay. When there is a lot of fear, people sell even quality assets. A disciplined investor stays calm in both of these extremes. They know that it is not necessary to take action every day. Patience does not mean being lazy. It means staying prepared and taking a confident decision when the right opportunity arrives. Emotional control has played a big role in Buffett's success. Instead of running after the crowd, he kept trust in his own analysis. The biggest mistake of a common investor is that they change their strategy after seeing others profit. Then, seeing a loss, they exit even faster. Consistency is very necessary in wealth building. If you change your plan every month, compounding will not even get a chance to work. Buffett's formulas apply not just to the stock market, but to life as well. Keeping on learning, maintaining patience, understanding risk, choosing simplicity, and maintaining discipline, these work in every field. But there is an important caution here. Becoming an investor like Buffett does not mean that everyone will earn money like him. No formula in the market gives guaranteed wealth. His principles provide direction, not a guarantee. The result will depend on your income, saving rate, investment choice, time, discipline, and risk management. Buffett's lessons are very relevant for today's Indian investors. Here too, people forget long-term wealth creation because of tips, WhatsApp groups, and short-term trading. A person who wants money only quickly often makes mistakes quickly. A person who invests after understanding creates a strong base slowly. Buffett's thinking says, first make yourself an investor, then choose an investment. If the mindset is weak, even the best stock can become a wrong decision. Many people do not create an emergency fund before putting money into the market. Then, as soon as a little need arises, they have to sell the investment. This stops wealth creation. In financial planning, insurance, emergency funds, debt control, and investment all play different roles. Buffett's disciplined thinking says that the foundation must be strong. If a person has a high-interest loan and is looking for quick profit in the market, it can be a risky decision. First, cleaning up personal finance is necessary. Expenses control, saving habit, and long-term goals should be clear. Only then does the investment journey become stable. Buffett also showed that character and reputation are more valuable than money. If trust breaks in business, even the numbers weaken. An investor should also look at the company's management. Profit alone is not enough. The management's honesty and capital allocation are also important. Good management considers the shareholders' money as its responsibility. Poor management can also harm the company's growth. In Buffett's Berkshire culture, trust, decentralization, and long-term ownership have remained very strong. This culture became the backbone of his investing style. When Greg Abel took over Berkshire's leadership, the biggest question in front of the investors was whether this culture would continue in the future. Buffett showed the same principle in the leadership transition that is seen in investing: long-term planning and trust in the right person. From this we learn that wealth is built not just by money, but by systems. If the system is strong, the institution can continue, even after the person changes. There is another depth in Buffett's simplicity. He stayed away from show-off and focused more on business substance than a flashy lifestyle. In today's age of social media, people are busy showing off wealth. Buffett's story is a story of building wealth and managing wealth, not showing it off. If you really want to adopt his 5 formulas, start with a book, not a tip. Start with patience, not panic. Before every investment, ask yourself 3 questions. Do I understand this? Is the price reasonable? Can I hold this for a long time? If the answer to these questions is not clear, then it is better to pause the decision. The market will always be there, but your capital is limited. Warren Buffett's biggest lesson is that money is not made in the market, but in behavior. If the behavior is right, even an ordinary investor can avoid extraordinary mistakes. His story does not say that every investor will become a billionaire. It says that financial life can become stronger with the right habits. In the end, the suspense is, what will you do in the next market crash? Will you sell in panic, run after the crowd, or sit calmly like Buffett and look at the quality of the business? Because the beginning of becoming rich does not happen with a secret stock. It begins on the day when the investor leaves behind the restlessness of becoming rich quickly and adopts wisdom, patience, and discipline.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.